In the world that we live in now, it's about managing money. It's not just about investing your own money. So I think if you have a successful track record operating, investing, or financing, and have institutional partners in your business, I think if you're successful, what I've seen in my career is it's pretty rare for institutional investors to pull their money out from successful partnerships, whether it be on owning real estate or developing platforms that provide products on the financial services side. So success breeds success.
Welcome to Deal Flow with me, Michael Polio, the go-to destination for private equity and real estate professionals, including institutional investors, sponsors, and market experts. Each week, I talk with industry insiders on everything real estate, capital, and prop tech. Sandor is the co-founder and managing director of Peak Hill Capital's U.S. high-yield investment business. With 30 years of investment experience, he holds an extensive track record structuring investments in multifamily, student, manufactured, and built for rent housing. Sandor previously led originations for Walker & Dunlop, where he generated over $1 billion annually in GSE compliant value-add multifamily mortgages and preferred equity investments for Walker & Dunlop and Blackstone Mortgage Trust. Sandor was also a managing director for Wachovia Securities in their real estate investment banking team, responsible for originating and underwriting real estate structured products, including CMBS, mezzanine, and preferred equity products. Sandor has a BBA in international finance and marketing from the University of Miami, Florida. Sandor, thank you so much for joining us today, and thank you for joining us on the Deal Flow podcast.
Yeah, thanks for taking the time. Thanks for having me, and look forward to following up on our conversations from the NMHC.
Absolutely, me as well. I'm looking forward to talking with you more about your background. So I know I gave you a bit of a bio, but if you wouldn't mind, just in your own words, go through your background and what you focus on today.
I started my first job in mortgage banking. They had a need in asset management and servicing, and I then, wanted to make money and get into sales and production. So I quickly jumped into dialing for dollars. One of the things I like to share kind of about my career is that, when I was in servicing and asset management, I kind of learned real estate the old school way, where we used to have to drive to properties and take photos and write down phone numbers and call leasing agents to get rental rates and find out vacancies. I quickly learned that, some properties you had to make a U-turn. Starting off my career, I was in an asset management servicing role before I, started dialing for dollars and moved into sales and production. But in the early years, and kind of the early 1990s, the way you kind of did asset management and underwriting was you would go look at properties, you would take photos, you would drive the market, write down phone numbers of leasing agents and call to get rental rates and occupancy. CoStar didn't exist. You kind of learned real estate more hands-on, as opposed to having all this data aggregation that was out there. And I found that was very useful in my career. As I kind of moved into the origination side, on the analytical side, to me, a means to an end to getting to sales and production where the money was. So it was, how do I, get my own client base, and, how do I use technology to find who needed mortgages? And we spent some money on some software to figure out who had maturing debt and what their interest rates were and what we could offer them. And I remember back in, this was now, the mid 90s, telling people they could borrow 15-year fully amortizing money at 7 3/4 on their industrial buildings out by the airport. People were very excited to talk to me about those opportunities because they were paying significantly higher interest rates with the banks. So, a little bit of context for today, when we see rates where they are, people are, squeamish about interest rates around 6% because we've come through a period of 3% financing for so long. But it wasn't that long ago that some of us that have been in the industry for 30 years have seen a very different paradigm exist. Another thing that was interesting in my career, this was also the mid 90s in mortgage banking, the conduit world was launched. The CMBS business kicked off in the mid 90s. And that sort of revolutionized financing in the sense that 30-year amortizations were rarely provided by lenders. It was mostly an insurance company world, and 25-year amortizations was for, the better assets. And, a lot of institutional quality assets were 15-year and 20-year fully amortizing loans. And CMBS just gave a much lower constant available to investors, not just in multifamily, but in all asset classes. And, in the early days of CMBS, the Nomuras of the world, they were very aggressive in getting their product out, and they were making very wide margins in commercial real estate lending. I mean, these were 6, 7, 8 point trades back in the day. And, that world has dramatically shifted over the past few decades as it's sort of become a commodity. So it was fun to sort of see the market change from that. We went from 7.5% interest rates and 20-year amortizations to doing deals on 30-year amortizations at 5.5% interest rates in a decade, and it dramatically changed the cash flows in deals
and the values as well, right? So you had significant changes in the values, which allowed for this additional financing and
yeah. And with that, we sort of started to see then, what was sort of a mom and pop family business started to become more of a promotion business and an institutional investing business. And we saw a lot more people buying property with the idea of trading in 3 to 5 years. And that wasn't necessarily, for me coming in and working at a company that had a $1 billion or $2 billion of a servicing portfolio. Most of the loans were, as I said, 15 and 20-year fully amortizing loans, and they were, 7 to 10 years into their life, and they were mom and pop owners, and it was a very different landscape to what we were now seeing in the transaction market.
Mm-hmm. Yeah. So I guess, so that brings you through to the 2000s a little bit. I wrote down some notes and some of the things that have changed since the 90s to now. Certainly that's a 35-year period. Tell us a little bit about what you're focused on, now, and then I'll kind of jump around to some of the topics that you mentioned.
So today I'm starting my own kind of fund management business with a partner in Canada who has a successful Canadian mortgage business based out of Toronto. And what we're offering in the U.S. now are 2 products. We're offering preferred equity on multifamily investments, and we're specifically investing behind Fannie Mae and Freddie Mac. And the other product we're offering is first mortgages, where we basically have a leverage financed vehicle that allows us to provide, $5 to $20 million mortgages. Again, same product type, multifamily, student, BFR, and again, typically not the most institutionalized of deals at the $5 to $20 million space, more of a mom and pop market. And our preferred equity strategy, kind of behind the agency, just kind of more of a middle market, sort of local, regional, institutional type scale and size, where we're doing $40 million transactions where we're taking $5 to $15 million in the first mortgage is another 20-30 million, if you will. And on that strategy, we're targeting 14-15% preferred returns and with an accrual feature. And it's sort of unique in the sense that not everyone in the world likes to invest behind the agencies. They very much limit your abilities to enforce rights that are typically permitted as mezz lenders. And since they don't permit mezzanine financing, you have to do it in the form of preferred equity.
Tell me a little bit about that history of moving from the mom and pops and the longer duration hold periods or longer duration pieces of debt to shorter duration, and how that's affected the market.
Well, I don't want to sound cynical, but it always feels like Wall Street knows how to create products to create more products to sell. And, it just simple math. If you take away the 20-year fully amortizing mortgage and you replace it with a 10-year mortgage and a 30-year amortization, you're going to need to refinance properties more often. I think what, we were seeing in our portfolio was for investors who had 20-year mortgages and had, been outstanding for 12, 13 years, they had phantom income issues with regards to, their depreciation. And they also had a ton of equity tied up in their properties and call protection that sort of limited, their appetite to pay penalties to get out of it. So the market, even the long-term holders saw some value in the new product. But the new product was able to bring in, new types of investors. And, you started to see more of this introduction of value add financing. And, the CMBS market, initially was very focused on 10-year paper and slowly morphed into providing 5 and 7-year paper. I think part of that was the profitability. A 1% fee or 1% earnings on a 10-year fixed rate deal is about 14 basis points, and it's about 25 on a 5-year deal. So if you imagine trying to charge 7 or 8 points on a 5-year deal, it's a little lumpier in your pricing than on a 10-year deal. But the market, soon came to bear, 5 and 7-year CMBS, and I think that again, it was one of those products that Wall Street figured out how to provide its clients, and it was one of those products that helped deliver more business to the industry because a typical 5-year deal would stay outstanding, at least half as long as a 10-year piece of paper.
Sure. Would you say that it was the Wall Street debt side of the house that was sort of driving that? Because obviously, there's also the equity side. They're looking their fund life, how long they want to recycle their capital, right? So you're matching your business plan to your debt, to your equity. So now everyone seems to have come down this spectrum and said, hey, everything's a 5-year deal. We want to get in and out in 5 years across the investor side, the equity, the GP wants to do that to realize their promote, and then the debt. What do you think was driving that? Was that the equity side, the debt side, or did it all kind of happen at the same time?
I think the debt became, and I'm biased because I did mostly debt in my career, but the debt capital markets, starting from those 7-point trades down to thin margins at the GFC where deals were getting priced at like swaps plus 38. We saw basically that, from the mid 90s until the GFC in 2007, we went through this great boom market in real estate. And I remember because I was at Wachovia at the time, and we were the largest CMBS player in the country, and we were, selling the track record of the performance of our bonds, and our default rates were decimal points of a percentage. They were almost non-existent. So you saw this capitulation of lenders willing to work for cheaper, and the bond buyer appetite was voracious because of the performance track record. And sure, as we all know now, there was some manipulation and synthetic paper that helped create some of the bubble that ultimately burst. But spreads just drove in so tight based on the performance of the underlying bonds that the market was offering a product that was basically gobbled up by everyone. So the traditional lenders in real estate were now buying this paper. So getting a 20-year mortgage from a Nationwide or a Prudential, they were now also buying CMBS, and they were sort of, helping fuel this 800-pound gorilla in the financing world. So you couldn't avoid it. You really couldn't find deals that weren't getting done with, without CMBS in the heyday of the real estate boom before the GFC.
Yeah, and I think the that's comparable to a little bit of the bridge financing that we saw in the more recent crisis in 21, where everything was being priced to the most high octane type of debt, right? Because that was pricing, valuations was priced off that, because that was based on cash flows. And so if you were able to get a 3% interest only, note with no call protection that you could refi out, or you had to refi out within 3 years, everyone was sort of pricing to that. And then when that changed, obviously now we're still dealing with the effects of that in today's market. Could we talk a little bit about CMBS and I think and then agency financing, Fannie Freddie? Obviously, you guys deal a lot in Fannie Freddie now, being behind preferred in that stack, as well as competing. It sounds like in some cases with small balance agency and traditional. Did you speak to some of the difference between CMBS financing and Fannie or Freddie financing? Talk about the spreads, default rates, risk tolerance, that sort of thing, maybe even process, anything you could speak to that would, help listeners who have a limited understanding or want to learn more about that.
The CMBS market for the last, 15 years has sort of trailed the agencies from a pricing perspective. And it's been pretty sizable. We briefly had a conduit at Walker & Dunlop and we launched it right around the same time that Freddie Mac launched the Freddie K program, which was their securitized multifamily product. And what we found was we were typically about 40 basis points wide of them. So when we were originating deals and getting bids from our sales team that was looking at Fannie, Freddie, or our product, the deals that sort of ended up, having a pulse with the CMBS side was mostly deals that had were in markets that the agencies didn't like or had sponsors that had scratch and dent credit. It was sort of perceived as if we were sticking a multifamily deal into a pool, the first question the B buyers were going to ask was, what's wrong with it? That sort of, still remains true today in the sense that the agencies still have dramatically better pricing than CMBS. And with that, because everything is debt service coverage constrained, it allows them to generate more proceeds. So the combination of better pricing and more proceeds, very difficult to beat that. So I think in the last couple years, we're starting to see some appetite from the market to take CMBS because they figured out a way to provide 5-year interest only paper, whereas the agencies on 5-year money, unless it's low leverage, will typically only allow 1 to 2 years of interest only. And as we're going through sort of this great reset on valuation in the current landscape, more and more investors want that longer term optionality of 3+ years. I think there's plenty of people who are kind of writing that check right now to right size their deal and get new fixed rate financing. They want some prepayment flexibility, but they don't want to be refinancing in 24 months. They're really hoping to get through this cycle and get a little more duration to make sure that they're not left, with an unknown, market for financing. I think most people believe that, rates aren't going to come plummeting down, and the more duration you have, the more chance you have to grow out of your, financial stress through the revenue side of a strong economy.
Yeah, no, I mean, we've been evaluating CMBS versus agency for some of our deals, and we're finding that, to your point, with the 5-year IO with the CMBS, they're also underwriting to a lower debt service coverage ratio, and they're largely able to give us, in some cases, more proceeds than agency. But if you look at the back end of that, I mean, CMBS default rates are significantly higher than agency default rates. And presumably that might have to do with the fact that most of the time borrowers are or rather they're getting excluded from agency and going to CMBS, and perhaps maybe agency's doing a good job of limiting its risk, right? And hey, I only want to, the CMBS dollars are going to go into riskier buckets. They have higher margin, on this, or higher spreads. And that consequently also leads to higher default rates, and which is appropriately why they're asking for higher spreads. I mean, is that something that you guys saw during your career, that CMBS tends to bias towards the riskier type of deal with the higher, expected default rates over time, or what have you seen?
I don't think CMBS is that selective. I think CMBS will eat what they can, and they'll try to figure out how to grab as much market share. If they could compete on pricing with the agencies and do what they were doing, they absolutely would go there. It's just a function of their inability to do so. So it's just the adverse selection that they're ultimately leading to those metrics. As I said, sometimes it's borrower based, sometimes it's market based, and oftentimes it's leverage based. I'm not to say it's a bad product. I'm not trying to say that their default rates in multifamily have been.
There's opportunities for where CMBS makes sense, but it doesn't necessarily mean that it makes sense usually because sometimes you have a riskier profile, and therefore CMBS is.
Yeah, I think in my career, if I looked at risk, the deals that don't perform well in tough times are usually sponsorship driven in terms of their ability to manage through difficult times, either hands-on level or financially to write a check if things needs to be right sized. I think that's probably a bigger part of a predetermining factor than some of the underwriting between agency and CMBS.
Yeah, that's an interesting point. And then you talked a little about the trading versus the investment. We talked about rates over time, how, with the context of history, our rates today are relatively low, and we've never really had any better, on a 10-year rolling basis than we have it now. Rates are low, amortization periods are long. We're getting more IO than we ever did. And so, maybe that's a good place to talk about your rate outlook. And then we'll talk a little bit about Peak Hill, I think, and what a little bit more specifics around the preferred products that you guys have and the mortgages that you guys can originate. Show us our crystal ball. Give us a crystal ball outlook on rates. Tell me
my
exactly where you think rates are going to be at the end of the year on Christmas Day, 2025. I want it to the basis point, please.
I sort of think that my crystal ball says that things will look pretty similar at the end of the year than they do currently. I think on the short term side of things, could we see a 50 to 100 basis point drop in rates this year? I think that's probably the likely range, the likely outcome. Would I be shocked if it was a 250 basis point drop in short-term rates? Yes. Would I be shocked if there were zero rate cuts this year? Probably not. The economy seems to be doing well. I do know that in my history, it seems that clear that politics usually trumps economics. So the economic forecast might be easier to digest than the political forecast right now, and that could be the thing that swings all predictions kind of off course this year. But the economy continues to grow. Inflation is still sort of here around 3%, which I don't think is a bad number given the debt that we've amassed as a country. That the economy continues to grow at 3% might be not the worst thing in the world. It's not great for those of us who do more business with lower interest rates. I'm just not convinced that waiting for interest rates is a smart strategy. The investors that I've seen do really well in their careers have never made money gambling on interest rates. I haven't seen anybody in the real estate sector show me they made all their money because of interest rate forecasting. So I'd like to think that we make decisions based on where we're at, where the rates are, not where guidance is, because I think the last 2 years have shown us that the forward yield curve has been dramatically mispriced and inaccurate. And so many people were sort of banking on that as their excuse to kick the can down the road and not make decisions.
Thank you for that on rates. I think it's hard to predict rates, and I would agree that probably predicting rates is not the thing that leads to long-term success. Let's shift over for a minute and just talk a little bit about Peak Hill and some of the products that you offer. Earlier in the pod, you were discussing your preferred equity product and how you sit behind agency. Could you speak to the implications of that and why that is something?
Yeah, so in the agency financing space, you're somewhat dealing with an entity that wants to make sure that the passive capital is exactly that they're not going to become the borrowers, and as a result, the documents are sort of set up to give you limited rights and not force yourself into the ownership, because they've underwritten the owner, and in most cases they've worked with the owner who has operating experience, and that's what they view as the top priority in their org chart. So that's sort of the first part. The documents themselves have this language differentiating between hard and soft pay in the preferred equity, and typically in a preferred equity investment you're going to have a total rate of return, so call that your 14% return that you're looking for, but you'll have a current pay metric, and the agencies have some requirements on the amount of current pay that you can charge, and they want to make sure that as part of the underwriting that there's enough debt service to make the current payment at closing, and they want to make sure that current pay obligation that could trigger a default doesn't change, it doesn't increase. So typically in a preferred equity investment that accrues, because your balance starts to accrue you want to start getting a higher current pay, or else the percent that you're accruing will increase every year. The agencies don't permit that. So if you say you want a current pay of 8%, the first part is, how does that underwrite from a debt service coverage perspective? For example, if it only underwrites to a 105 debt service coverage with Freddie Mac at a 6% current pay, that's the maximum hard pay amount that you're allowed to charge. And if you want to have up to 8% current, you would have to then charge a 2% soft pay above the 6%. And the difference really is the 6% is where you get your enforcement rights if they don't make those payments, whereas any other payment above that 6% doesn't trigger any sort of actions that Freddie Mac will entertain to allow you to step in and enforce your rights and remedies to become borrower. And that, the challenge with that obviously is, not getting paid current could be a cash flow shortage, or it could be an operational challenge, or it could just be a decision by the sponsors to suspend distributions. And any and all of those things could have different enforcement rights within a typical operating agreement. But when you're negotiating your preferred equity with the agencies, they'll put some approval rights in that operating agreement that will, again, prevent the preferred equity investor from having rights and remedies for certain events of default.
And I think you also work for the pref. What's your typical size?
We everything we're doing right now in PKIL is sort of being a young company in the US is we're trying to invest in check sizes of $5 to $15 million. One, it helps us get more diversity with what we're doing as we put money out. But we also think that in general, there's a certain check size that's deemed to be below institutional. And as you get into those smaller check sizes, you typically don't have as many competitors in the space. So we found in my career that, under $20 million on the first mortgage space, there's not a ton of groups outside of the community banks that really make their living in that size and space. It's not to say that there aren't groups that will, but if you count the number of lenders that do transactions 25 million and up, and then you count them 15 million and below, it probably shrinks by about 80%. Sort of pretty similar with the pref equity space is, the groups that do this on a national basis want to put out check sizes 20 million, 15 million and up, and there aren't too many interested in doing $7 to $10 million checks. Typically, when we're doing those smaller deals, if there's competition, it's coming from a local family office or a local player, not a national player. Again, because it's hard to scale your business if you've raised a lot of capital by putting out $10 million checks.
Right, and as a result, you have less competition, and then presumably you're able to get a better yield with less competition relative to.
It's certainly the assumptions. I think right now getting more yield is tough to measure because there's not a ton of transactions getting done, but that's definitely the thesis.
That's all things being equal in a perfect world, theoretically. So then when we think about what is that transaction size overall, you basically have, your first lien up to say 60% of your loan to value, your pref is going up another 10 points or so, maybe 15 points, and then the commons that last 25, or and that would be a $40 million transaction. I'm just trying to figure where does this slice into? Because if you've got a $15-20 million first lien, you've got a $5 to $10 million second, or preferred in your case. And then
it's a great question, and I think we both know there's not a lot of transactions getting done today because that bid-ask spread has a gap of about 10%, depending on if you're the buyer or the seller. So I think the metrics that you laid out are sort of in line with where the seller valuation is. That I've only got 60% debt on, and you're taking this up to 75, 77%. But if you kind of put it under a fine-tooth comb and you look at today's cap rates, maybe you're in the low to mid 80s on your true value today. And as you get out of the deal, you're probably in that 75 to high 70s LTV range. And again, that's also a function of how much you accrue. So that's a
Yeah, and it's difficult when you're buying at a 6 cap, right? And then trying to allocate that through the capital structure with what first liens want on the debt, what the pref wants, doesn't leave a lot left for the common, especially with how much the common needs to
well,
take
and that's what's sort
on
of
the
unique
capital
about the
structure.
pref behind
Uh,
agencies. Unlike mezz, most pref in multifamily will allow some leakage back to the sponsor. It's not sort of just a true payment in kind and sweep all cash flow. So there is the ability to pay the investors. Most of the deals we're seeing that are on acquisition today, they're looking at some level of upside to justify bringing in the pref, that there is a value add component. And on the recap
mhm.
deals that have legacy 22 and 23 debt, that those deals might just need the pref just to right size their first mortgage. One more thing I should also, kind of going back to the
Right.
earlier comment about what's sort of unique about agency pref is, if you want to go behind the agencies and do a value add deal, and I'm doing, let's say, an $8 million pref piece that has $2 million of capex dollars, all that money needs to be funded up front. It's not like a bridge loan where you could lend six and then do a future advance. Going back to that, the pref has to be fully funded and your current pay has to be tied to that amount. So it's another one of those things that sort of makes pref harder and harder to do, because a lot of the deals that make sense need a value add component, and you've got to put that money into the deal day one, and it's obviously expensive money.
Mhm. Right. Yeah. Yeah. No, definitely. Yeah, we've definitely seen some pref which tries to hold dollars back, but then charge for the full amount, right? And so they only provide the purchase leverage, and then they'll escrow the capex dollars, and but you're still on the hook for them, or there's some sort of forced funding mechanism where after 12 months you start paying the interest, which from the investor's perspective on as a preferred equity makes sense because that money is now allocated, it's reserved for this deal. But as the borrower, it's very difficult to justify paying interest on money that you won't give me, essentially, right? And then I'm also hamstrung in that I have to, not you specifically, but some of the prep that we've looked at, where they have the right to deny draw requests based on certain operating metrics, and sometimes you need the money to do the work to get to the operating metrics they want you to get to. So it can be a little bit of a circle where that money gets trapped in limbo, and we can't improve the asset, but yet you won't provide the dollars to do the improvements, and then we're sort of stuck in this. Well, we can't reach the valuation that we want to get to. We can't get to the NOI that we want to get to, but yet we're still burdened by the cash, outflow of the interest that we're paying on money that we haven't knocked out. So I think that can be a little bit of a challenge for pref. It's also been a challenge for the debt fund because that's certainly something they were doing as well. Um, so, um, you know, tell us a little bit. One more thing on the first lien, and then I'd love to hear a little bit about lessons learned in your career on what things that great investors do pay attention to. If rates are not the thing that drives strong investor returns, what do you view as the things that do? But before we get into that, you're the first lien mortgages that you're doing in that, I think you said about $15 to $20 million range. So you're competing with, you said, the community banks and then potentially agency financing as well. Can you just
On
talk a little bit
the
about
bridge
that?
space, we're typically looking at deals that are lease up deals or light value add. So we're definitely not competing with the agencies for the product we're doing. We're typically looking to the agency loan sizing as, how would we get out of the transaction? So
Yeah.
there's no shortage of deals today that are coming off construction loans that have equity in front of them, a good location, good market, but a banker that wants to have them pay off their their financing as soon as possible for a multitude of reasons, none of which are more important than exposure to a borrower or a particular market. So we're definitely seeing developers feel the squeeze from the banks on deals that need extensions. It's not very easy for them, so they're looking to get a lifeline. Oftentimes, the deals in the markets we like have some concessions that need to burn off, and we're going to be realistic about maybe that all doesn't happen in every market today, but there's a pretty clear path over the next, 6 to 18 months to believe that even in the heavier supplied markets that concession burn off is going to go away, and the tides will turn kind of pretty quickly the other way, where we start looking at a lack of new supply and development in markets in years 3, 4, and 5. That's going to make it a very good market for owners in a few years. So we're seeing a bunch of that, and then we're also seeing some light value add. Very common to see deals that are trading right now that are value add, where a seller is getting out of a property, but they've already renovated a third of the units. They've done the case studies, the sample deals to show what price points you have, and just an opportunity for somebody else to come in and just renovate some additional units. We're trying to be prudent. I think a lot of these older assets that were 70s and 80s and 90s vintage that we're looking at, we're making sure that as they're being acquired, they've had system upgrades to plumbing, electrical, windows, roof, parking, the heavy CapEx items that are already done, or there's a budget to address any major needs as part of what we're doing. I think the era of kind of slapping the lipstick on the pig is over, and plenty of people made money just coming in and renovated kitchens and baths and sold to the next buyer. But I think there's not a ton of people that are looking at older vintage assets with excitement and enthusiasm with inflation, that the operating costs aren't going to be a challenge. So we just want to make sure as we look at those older assets and markets that we like, that we're not left holding the bag with someone who didn't previously address those, or a buyer who doesn't have a plan to deal with those.
Right. And that's very similar, I think, to most sponsors are hopefully looking at those things as well, making sure that they're budgeting appropriately for the physical assets, not just a cosmetic renovation. You can only kick the can down the road so long as it relates to those physical improvements to PP&E stuff. So you spoke about the markets that you like. Maybe you could highlight a few of those markets, or generally kind of the themes of what you're looking for so far as market.
When I started off early in my career in South Florida, all I heard was about the demographic shift to the Southeast. And, I think fundamentally what you see over the long term is job growth and population growth is what leads to long-term appreciation. But also, you could look at, the comparisons between a California and a Texas and say, well, one has an affordable housing problem and one builds housing, anywhere and everywhere. So it's really sort of market by market today in terms of addressing, what the supply demand function is. But in the long run, if you look at the job growth and the demographic shift that's going on that was accelerated by COVID, I think the markets, that I like, particularly, from the Carolinas down to Florida, remain very exciting. I think, insurance is on everybody's mind as a risk, but it's still a relatively small percentage of operating expenses. And if you look at, the job growth and the population growth, I'm not seeing a lot of people that move down to those places, have their children there, with their kids wanting to move to northern states. So I think if you look at people in the Midwest parts of Chicago, where kids go off to college in the South, they're not flocking back home. So I think the demographic shift and the growth in the country is kind of pretty clear. So I think those markets are the most exciting long term, but they also have some of the most oversupplied, overbuilt, and concession driven situations today. But I think you can navigate through that as you structure your deals. So I don't think we're sort of revolutionary in terms of where we're going. I think that, I like to use Indianapolis as an example. It's a very hot market today. But I do remember earlier in my career seeing many deals that were owned and operated in Indianapolis as, older vintage value add deals where lots of money was spent on CapEx and renovations, and very little upside was returned on the revenue side. It just wasn't, in the market, the opportunity to push rent. So, I think there's pockets of Indiana as a whole that are exciting today. But again, it stems from job growth, universities, and you look at kind of the overlying, what's exciting about the market. Are people moving there? Is there education there? Those are the things. Those are the places you want to invest around long term, and not really deal with, you know, some of the risks of smaller tertiary markets that don't have the long term growth potential.
So eds and meds, follow the migration patterns, stay away from big government. The good.
Yeah, healthcare is also a big one. I mean, if I had to tell you, we've seen a lot of deals that we like that are based near a large hospital in a secondary market that has some growth there, and
Yeah.
that to me is always exciting. There's always demand around hospitals, so you add healthcare to that.
And there's definitely like a reflexive problem as it relates to, we have all these great migration trends in the Southeast, maybe the Texas markets, but then you've got the overzealous builders and developers who will, all build simultaneously 5 times the required demand. And then all of a sudden you're oversupplied and you've got a 18 to 24 month problem where you've got to deal with that until that right sizes. And then it's kind of a boom and bust of the business cycle relative to the long-term interest rate cycle. So, but yeah, no, I think if you can figure out a way to kind of enter and exit the market at the right times there and deal with those problems, or just be very careful when you're buying, looking at those supply and demand dynamics. Don't be the developer, just sort of like watch and see what happens. And then you can kind of take advantage of maybe buying at a great price because, there is a lot of supply, but if you're going to hold for 10 years, then it shouldn't really matter too much to you. You just have to forecast for that and kind of project for that near-term occupancy weakness. So just as we wrap up here, I'd love to hear, what you see as maybe the primary drivers. Over your career, you've seen a lot of people come into the industry and maybe, leave the industry. And then you probably have another group of people who have come into the industry and have stayed for the long term. So maybe could you speak to what provides the staying power for those investors, those either on the debt side or the equity side, that make it for the long term, that they're in and out of they're in the market for decades rather than kind of in and out
It's
of
funny.
the market.
I think the 1031 exchange is the best example as to why I've seen people married to real estate for life. There is no better tax shelter that I know for profits from selling a successful investment. So I think it is hard to divorce from real estate if you sell something with some profit in it. And I think that's a big part of why people who are successful in real estate keep their chips on the table. I also think that in the world that we live in now, it's a very it's about managing money. It's not just about investing your own money. So I think if you have a successful track record operating, investing, or financing, and have institutional partners in your business, I think if you're successful, what I've seen in my career is it's pretty rare for institutional investors to pull their money out from successful partnerships, whether it be on owning real estate or developing platforms that provide products on the financial services side. So success breeds success in that regard. So I think owning real estate over the long term is certainly a great way to build wealth, generational wealth. And, right now, I think there's a lot of young people that have gotten into the industry in the last 5, 6 years, 10 years. And as I went out at NMHC, and I'm sure people at the MBA will tell you, there's a lot of people not making money in our industry that maybe they're not in it for the long haul because they're more transactionally driven. But I think for people who are actually invested in real estate, I don't know that they're going to, take their chips off the table.
Got it. Well, great. Well, thank you, Sandor. I appreciate your time and for joining us on the Deal Flow podcast. You shared some great insights and knowledge within the credit space, the lending space, talk a little bit about preferred equity. If listeners wanted to get in touch with you or find out more about you, your company, and your products,
I'm at sbiderman at peakhillcapital.com, and Biderman is Biderman, or our website is peakhillcapital.com. We've got our U.S. businesses are on there, and all the different products we have here in the US. And would love to meet some of your pod listeners.
Well, great. Well, thank you so much. Thanks for tuning into this episode of Deal Flow. Don't forget to give the podcast a follow on Apple Music or Spotify, and subscribe on YouTube so you don't miss an episode. And of course, if you feel like someone else would get something out of this show, please go ahead and send it to them. Feel free to comment below with regards to future guests you'd like to see on the show, or get in touch should you think your knowledge or expertise would make for a great episode. Thanks again for me, and I'll see you next time on Deal Flow. Thank you for listening to Deal Flow with me, Michael Polio. We hope you gained valuable insights into private equity real estate and market trends. Stay tuned for more expert discussions and updates on the latest in commercial real estate and structured finance. Don't forget to subscribe, rate, and review on your favorite podcasting platform. Join us next time for more high-level conversations that empower your investment decisions and your operating results.